and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. On Thursday, Hindustan Unilever, or HUL as it is called, reported its results for the December quarter. India's largest FMCG company beat street estimates. FMCG results have been a proxy for how the Indian economy, especially rural Indian economy, has been performing. What do these results tell us about the rural Indian economy then? Bhaswar Kumar has the answers in the following report.
Hindustan Unilever, or HUL, reported a 7.7% rise in net profit to 2,474 crore rupees during the December quarter, beating street estimates. With 5% volume growth, the FMCG major's revenue grew 16% to 15,343 crore rupees. However, most of HUL's revenue expansion was price-led, not demand-driven. In its near-term outlook, HUL CFO Ritesh Tiwari said the company would be cautiously optimistic if commodity prices remained where they were. However, he cautioned that year-on-year inflation was still high and HUL expected growth to be price-led. The results brought a modicum of positive news for the FMCG sector and the overall economy. HUL, whose performance is seen as a proxy for broader consumer sentiment, said the slowdown in rural India was bottoming out. It added that the worst of inflation was likely over. Taken together, these developments would set the stage for a revival in volume growth. MD and CEO Sanjeev Mehta said demand had recovered both year-on-year and sequentially, particularly in rural areas. Citing Nielsen data, the company said while the rural FMCG market grew 4.8% in value during the December quarter, volumes fell 6.6%. However, this was still an improvement from June and July, when the market had declined 2% and 1% in value terms. Mehta said HUL was seeing green shoots, given that the FMCG market in rural areas had started improving. However, he cautioned that it was too early to declare victory and that while the situation was improving, there was still a long way before volumes and rural markets would turn positive. According to data from Bizum, demand from rural areas showed signs of recovery in December, declining 0.2% on a month-on-month basis compared to the 17% month-on-month decline seen in November. Akshay D'Souza, Chief of Growth and Insights at Bizum, told Business Standard that rural demand was almost on a growth path, adding if inflation continued to soften for some more time, it could spur strong consumption in rural areas. Rural demand has been under stress since August 2021. Companies were forced to increase prices and consumption was hit as a result. FMCG firms also had to cut the grammage of their packs to pass on some of the impact of high commodity prices. In 2022, high prices ate more into rural earnings than urban. A combination of factors, from the war in Europe to weather, impacted rural India. But the end of the year did bring some improvement in the situation. A Kotak Institutional Securities analysis revealed that real rural wage growth was negative for a 10th straight month in September 2022. The contraction was largely on account of elevated inflation. In rural areas, retail inflation has been consistently above the 6% mark since January 2022. Combined rural and urban retail inflation for the month of September surged to a 5-month high of 7.4%, before moderating to 5.88% in November. In December, inflation eased marginally to 5.7%, staying within the Reserve Bank's tolerance range of 2 to 6%. At 6.05%, rural inflation was higher than the 5.39% in urban areas. Higher rural inflation than urban throughout 2022 meant that people in rural India were affected more by high prices than their urban counterparts. Now, HUL sees the rural slump bottoming out. Against this backdrop, what do experts have to say about the economy of rural India and its consumption?
I think the rural demand is improving a little bit. I think one of the reasons is that the harvests have been good, And we also see the rural wages picking up a bit. I think though I think the speed is still very low. And on top of that, I think inflation in general has come down a bit. So all these are generally positive for private consumption demand. And I think from a farmer's perspective, the good harvest and slightly higher staple prices, particularly rice, wheat, etc. I think these add to their incomes. So there is some movement in rural demand, but don't forget, next in the coming fiscal year, we're looking at a slowdown. How sustainable it is, I think, will need to be seen.
Your inflation numbers have been higher in the rural areas, which means that the real purchasing power has come down. The second part is that there have been certain crops which have been affected in terms of their kharif output during this particular season. So part of farmer income has also been affected. And the third part is that we have seen that the SMEs, which are located in rural area, I think around half of the rural economy actually comprises non-farm income. That is something which is still struggling to get back on its feet. So given these conditions, I think that the pace of recovery in terms of rural demand will tend to be very gradual, impeded along the way by higher rural inflation.
So rural consumption, as per me, is expected to see a volume recovery in the upcoming months. And this will be majorly because of improved rural demand and lower inflation. Now we are seeing that the input prices is also stabilized. So we don't foresee the price hike in FMCG products in future. So that is also one of the reasons.
Given that consumption is the principal pillar of the economy, what can the budget do to support it in rural areas and for the larger rural economy?
I think the Manrega scheme should be kept as a safety net. I think if there is stress in the rural area, then it could be deployed. But in general, I would say more infrastructure creation is the only way out for sustained rural improvement and also improvement in demand. So maybe more allocations to rural infrastructure, etc. Housing particularly. I think these are the ones, these are activities, particularly housing, which involves construction, labor intensive activities, so it will provide jobs as well. So I think that's the route that I think budget will take.
See, the government cannot, in my mind, do anything decisively on the consumption part. But what it can do is to continue with the kind of support which has been provided to the rural economies. This has been done primarily through the NREGA program, which has been done through the PM Kisan scheme, where there have been cash transfers which have been given to the rural folks, something which will be helping to spur consumption. Now, to my mind, given the kind of limited space which is there in the budget, the government may not be in a position to increase these amounts substantially. So therefore, while there will be some kind of maintenance of government support in the form of these transfers, there may not be any kind of substantial increase because of the limited fiscal space which is there.
Consumption is expected to weaken in the second half of FY23, and economists expect this slowdown to continue into FY24. Given how important a broad-based recovery in consumption is to reviving the investment cycle, the government may have to provide some support to rural India in Budget 2023, despite its limited fiscal space.
Revival in rural consumption will indeed help India, which is poised to become the world's fastest growing major economy this year. Meanwhile, neighboring China, which is being pitched as India's rival by the West, is slowing down. Its aging population and policies are being cited as the reasons. For decades, China's population fueled its growth and that of the world. Now it is India's turn, which appears to have overtaken China as the world's most populous nation. So, what can India learn from its powerful neighbor on the demographic front? Tushar Verma brings the answer.
China has finally reached the historic turning point. In all likelihood, it is no more the world's most populous country. Last week, the country announced its first population decline in over 6 decades. China is now home to the world's largest population of older people, and it is fast losing the demographic dividend that it enjoyed over the last several decades. the baton has been passed to India now. According to estimates, it is now the world's most populous nation, and by 2050, it will be home to 1.67 billion people. China will have a population of 1.32 billion by then. The United Nations, up until 2019, had forecast that China's population will peak in 2031. Last year, after a revision in methodology, it found that China's population would peak in 2022, and going forward, the population will be in a decline. This comes at a time when China's economy grew at a meager 3%, which is its second lowest growth rate since the 1970s. According to the World Population Review, India's population was 50 lakhs more than that of China's towards the end of 2022. But India's total fertility rate, or TFR, has declined from 2.2 in 2015 to 16 to 2.0 in 2019 to 21, according to the National Family Health Survey. The required TFR for replacement, that is the rate at which population replaces itself from one generation to next, leading to a net zero growth, is 2.1. So, does India's reduced TFR suggest that India is heading the same path as that of China?
We are just experiencing replacement level of fertility. At the same time, India has huge socioeconomic or regional variation in fertility. So it is very unlikely that, India will experience the same kind of situation as such China. And when it comes for her, what lessons we can learn, one is, of course, there should not be cohesive policy, population policy. But, we in India, because there is extreme diversity even in fertility. So keeping certain limit, we can debate whether we want to control the family plan, we want to control the number of children or not. At the same time, we can also debate whether it is the number 2 or number 3 or number 4 we want to fix. But keeping certain cap is essential, because in India we have extremely high population density.
According to the National Statistical Bureau of China, the share of the working age population was 62% in 2022, a decrease from 70% last decade. China defines working age as between 16 and 59. In the case of India, the working age population share was 67% in 2020. According to a Confederation of Indian Industry report, India will add another 100 million people in the working age group by 2030. This comes despite the fact that India's TFR has been on a decline. In this scenario, what can India learn from China's population woes?
I think our population is an asset, honestly. So I feel like, the control measures that China had put down, there are various studies which have been done which talked about the few pros and the many cons. At that time, China was going through a massive food security issue. They couldn't feed their, population, and that's why they had to come to this one child, sort of a situation. India is not there. I don't think we have a challenge of, feeding our large growing population, but we are not at the point where we have to create these kind of very stringent and oppressive policies where, you have to restrict the number of children a family can have. So I don't think that's needed. I think what's needed is to figure out how do we capitalize our demographic dividend. It's an asset, and how do we see it as an asset? How do we put it to use? So I think, I don't think that, creating sort of these very stringent policies about one child, two child is needed in India, really.
According to the National Statistical Bureau of China, the key reason for the contraction in population was a decline in the number of newborns. Kang Yi, the head of NSB, said the main reason for decline in the number of births was drop in people's willingness to have babies, delay in marriage and pregnancy, and fall in the number of women in childbearing age. China's total fertility rate, or TFR, has been on a decline since the 1970s. In 2016, China ended its one-child policy in a bid to increase the young population. However, it did not work. In 2018, the TFR was 1.8, which fell to 1.3 in 2020. In 2013, the country allowed about 12 million couples to have a second child. However, only 12% of the eligible women applied. The population crisis unfolding in China has brought focus back to the debate on population control in India. China's one-child policy may have served the immediate purpose for which it was formulated, but in the long run, it has shown its drastic impact. India, on the other hand, does not seem to require such coercive population control. Instead, it needs to invest in its young workforce.
government, meanwhile, is giving final touches to its annual budget, which will be tabled on February 1st. So, how will equity markets behave in the run up to the budget? Will it finally see some decisive moves after remaining muted this month? Nikita Vashisht and Rick Scano answer in our next report.
Benchmark indices have more or less been at similar levels as that of the beginning of 2023 amid volatility, indecisive global cues, and the third quarter earnings. Last week, the Sensex rallied to a high of 61,110 and eventually settled with a weekly gain of 361 points or 0.6%, while the Nifty index added 0.4% to close at 18,028 levels. On the contrary, broader indices ended on a negative note, with the BSE mid-cap index slipping 0.7% for the week, while the small cap shed 0.8%. With just 1 week left for the union budget, growing anticipation around new policy announcements and SOPs for businesses could trigger a rally in infrastructure and economy-facing stocks, analysts say.
A budget proposal that can be predicted with a high level of certainty is that the thrust on infrastructure investment will continue. The government has been doing the heavy lifting in capital expenditure during the last few years, and this should continue to sustain the growth momentum in the economy. Therefore, capital goods stocks are likely to rally in the run-up to the budget. This has already begun. Capital good majors like L&T and ABB are already up more than 9% year till date. Cement is another segment which can participate in the pre-budget rally. Proposals to boost the rural economy and rural consumption are likely. Anticipating this, rural-oriented stocks, including FMCG, may rally. Broadly, the budget is likely to focus on sustaining the growth momentum in the economy. Therefore, all domestic-oriented segments, including banks and autos, might benefit.
Besides, the holiday shortened week will also see earnings action, with almost 300 companies scheduled to release their third quarter results, including frontline majors: Axis Bank, Maruti, Bajaj Auto, Tata Motors, Bajaj Finance, Cipla, Dr. Reddy's, and NTPC, among others. Markets will be shut on Thursday, January 26 on account of Republic Day. Hence, the monthly FNO expiry will take place a day before on January 25th. The Nifty so far this month has managed to sustain above the 18,000 mark despite repeated bouts of selling, though technical analysts say that the index has broken out from its consolidation phase.
The Nifty was consolidating in a narrowing range since the past 3 weeks, and last week it has broken out of that consolidation on the upside. The breakout was accompanied with a positive crossover on the daily momentum indicator. Thus, both price and momentum indicator are suggesting a further upside in the index. The up move can stretch higher till the zone of 18,460 to 18,500 on the upside, where resistance in the form of the 61.82% Fibonacci retracement level of the fall from 18,900 till 17,760 is placed. In terms of trading strategy, we believe that the Nifty is in an uptrend, and hence the strategy to trade in Nifty should be to buy with a stop loss of 17,850 for target of 18,460 to 18,500 on the upside.
Globally, investor focus this week will remain on manufacturing PMI numbers from Japan, Eurozone, and the US. Back home, shares of ICICI Bank, Yes Bank, and Ultratech Cement will be eyed today after the release of their third quarter results over the weekend.
Infrastructure development is likely to remain the key focus area in the upcoming budget. In the previous budget, the government had allotted 4,710 crore rupees for the country's first regional rapid transit system, or RRTS project, which will connect Delhi to Meerut. In our decoded segment, we'll tell more about RRTS. On Thursday, a regional rapid transit system or RRTS train achieved a top speed of 160 km per hour during a test run on the 17 km priority stretch from Duhai Depot to Sahibabad in Ghaziabad district. It is among the top speeds achieved by any train in India. In common parlance, this is called the rapid rail system. Thursday's test was undertaken to check the speed and infrastructure of the RRTS. The RRTS is a dedicated, high-speed and high-capacity rail-based commuter service that will connect different regions in the National Capital Region. It will offer high-frequency point-to-point travel at an average speed of 160 km per hour. The travelers will be able to travel long distances in less time and with fewer stops. RRTS will provide a multi-modal integration connecting the railway stations, bus depots, airports and metro stations. The distance travelled on Delhi Metro is usually short and has several stops in between. The RRTS, on the other hand, will be used for relatively longer transits and will have fewer stops. RRTS will also be faster as compared to the DMRC's train. The operational speed of RRTS will be 160 km per hour, but for Delhi Metro, it is usually around 80 km per hour. In 2005, the Planning Commission formed a task force under the chairmanship of the Secretary of the Ministry of Urban Development to develop a multi-modal transit system for Delhi NCR. It proposed to connect urban, industrial, regional and sub-regional centres through a fast rail-based RRTS to enhance the connectivity within the NCR. The main objective was to reduce the dependence of commuters on road-based transportation. It also identified 8 corridors. In Phase 1, 3 corridors were accorded priority. These are Delhi Ghaziabad Meerut, Delhi Gurgaon Alwar, Delhi Sonipat Panipat. In Phase 2, 5 other corridors will be constructed. These are Delhi Faridabad Palwal, Ghaziabad Bulandshahr Khurja, Delhi Bahadurgarh Rohtak, Ghaziabad Hapur, Delhi Shahadra Bagpat Barod. The centre formed a joint venture named National Capital Region Transport Corporation or NCRTC with Delhi, Haryana, Rajasthan and Uttar Pradesh. NCRTC is being funded through an official development assistance loan from Asian Development Bank and Asian Infrastructure Investment Bank. The work first began on the Delhi Meerut project, which will have 22 stations. This project's 17 km Sahibabad Ghaziabad Guldhar Duhai section is currently the priority. It will be completed by March this year. The 164 km Delhi Alwar will become operational next. The train will have economy and business class seats with transverse seating. French manufacturer Alstom will supply the coaches. It built the first train for the Delhi-Meerut route in May 2022. It will deliver 210 coaches for this route alone. The fares have not been announced yet, but the ticketing will take place through an automated fare collection process using QR codes. The RRTS network in Delhi NCR will improve connectivity in the region and bring the National Capital Region at par with other metropolitan regions in the world. RRTS will be at par with London's Crossrail, Paris RER and Munich's S-Bahn systems.
By the nation's trusted bank, SBI, the banker to every Indian.
RRTS is expected to reduce the travel time between Delhi and Meerut to just 37 minutes. That is all for today. For more news, views and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.